China's economic collapse, and no country, including the U.S., is immune from its fallout. What does this mean for America's economy? And more importantly for you? Stay tuned. I'm your host, Steve Metre, and thanks for joining me today. In our show today, if you think China's economic troubles won't reach your doorstep, well, think again. I'm going to show you exactly how their downturn will ripple all across the U.S. economy and the rest of the world. Now let's head over to Bloomberg, where he picked today's story up with the headline, is China's industrial profits set for the steepest annual drop since 2000, because China's problems start with its manufacturing base. And no matter what country you are in the world, the most critical part of the economy is not the consumer, it's the manufacturing base, because when the factories are running and humming, well, it tells you the economy is growing. And in China's case, when you're seeing profits decline at the fastest pace since 2000, it's a massive warning sign for what's happening in China's economy and what's about to happen all over the world. Industrial profits at large Chinese companies fell 7.3% last month compared to a year ago. While easing from the double-digit declines in the 3 previous months, the drop deepened a slide in profits this year to a 4.7% decrease over the first 11 months, putting the year on track to be the worst on record for industrial businesses. And for China, this is even particularly worse than everyone else because they're the world's largest exporter, and that means they export inexpensive goods all over the world. So if their manufacturing base is slowing down and we're seeing industrial profits collapse, what it's telling us is demand from European consumers, Asian consumers, American consumers, from people all over the world is declining, and this is putting China's economy squarely in the direction of recession. Now, we know it's already likely in the early stages of it, but as you're about to see, it's going to get even worse, and this is going to affect the U.S. economy in a major way and workers all over the world. And we can take a look and see the impact on demand. When we look at the U.S. data here, we're going to look at industrial production in blue against real retail sales, that's inflation adjusted in red. They're both on a year-over-year rate of change, and what we can see is the decline in industrial production starts with the consumer. As demand for consumer goods start to slow down, what you see is eventually hits the industrial base. We see that here around 1994. Once again in 1999, the slowdown took us right into the dot-com bubble. We see it happen starting back around 2005 to 2006. Retail sales started to slow down, manufacturing started to slow with it, and then they both put us right into a financial crisis. And we see that after the pandemic, where the decline in retail sales has sent industrial production lower. And many believe the U.S. economy is about to turn higher, sending in both industrial production and retail sales up. But as you're about to see, what's happening in China is just a proxy for what's about to happen all over the world. The results suggest Beijing's most extensive efforts to revive the economy since the pandemic have had a limited effect in lifting demand. And that's something we've talked about, because what has Beijing done? They've tried to prop up their banks by injecting cash. They've given money to the real estate developers through cheap loans. They've done everything but send money to the consumer, and then they step back and wonder why demand is falling. Well, it's not just an internal issue. It's not just a domestic issue with Chinese consumers. Again, it's about consumption from everyone all over the world. We're seeing the post-pandemic fallout begin. It's hitting China first, which makes perfect sense, but it's going to ripple all across the world. And industrial profits are a vital gauge of the financial health of factories, mines, and utilities, shaping their investment decisions in the months to come. But more importantly, it's all about labor, because when you think about it, if profits start to decline, what is it telling us? That demand is going down and that suppliers are getting squeezed at the margin. So when they've cut expenses in every possible way and they still need to cut more, well, what happens next is they start slashing hours, then they start cutting jobs, and at that point, it's too little too late. There's nothing Beijing or any other country can do to turn their economy around. And we can see it has a huge impact on their investment decisions as we turn back to the U.S. data, as we look at industrial production against commercial industrial lending. That's shown in red on a year-over-year rate of change. And what we can see is as industrial production slows down and eventually contracts, well, we can see demand for loans go with it. And we can see this all throughout the U.S. economy going back to the 1960s. And you can see, again, slowdowns in industrial production lead to a slowdown in loans. And so as we see retail sales decline, We know industrial production is going to decline, and so too will lending. And this is a huge issue because we see that producers are really what are the big drivers of loans. Because when you think about it from a manufacturing standpoint, they get a big order in, well, they don't have the money to fulfill it, so they go to the banks, they borrow money against the order, they go out and they buy the raw materials, they hire the labor they need, they get the equipment, and then they produce the end product. And that's what's driving, of course, what we see in the banking sector. Now, the problem here is when we see a slowdown or contraction in commercial industrial lending, it's really dangerous for a debt-based economy because what it means is money is being destroyed. So when you pay back the principal value of a loan, whether it's all at once or through a regular monthly payment, that money is destroyed from the financial system. So to see a creation of money or a net creation of money, we need to see more new loans originated than old loans are being paid off. And in this case, we're not seeing that. It's a dangerous sign for all economies, particularly the U.S. And we can see it's going to have an impact on the stock market as well, because as we now overlay the NASDAQ 100, that's shown on a year-over-year rate of change against industrial production, you can see the relationship. Now, it's not perfect, but you can see they generally go in the same direction, except for now. Industrial production has been slowing and is even slightly negative, whereas investors are betting on a completely different outcome than the U.S. economy is pricing in, suggesting we could see a major move down in the markets into the first of the year, because what we know is after the holidays, demand from consumers plunges, and this could, of course, have a ripple effect, not just across the economy, but the stock markets are as well. But if you're looking to be in something that makes money, well, check this out. That trade we put on back on December 23rd, well, it's up 1.31% and looking to break out. And here was the note we gave to our Momentum Timer Pro subscribers. It closed over its 10, 30, and 90-day volume profiles, as well as its 6-month, 1-year, and 2-year volume profiles. We put a buy it open. We think the upside target here is somewhere around 10%, and you can jump in there. You want to trade momentum? Well, we show you how to do it better. But maybe you want to beat the machines. Well, we just put out a trade on our hot list yesterday, and this trade is already up 1% since we put it out to our subscribers before market open, and we think this trade is going to break out as well. You want to trade against the machines that are forced to be buyers when, of course, we see price move up and ride the wave. We'll jump on that, because here's the deal. The 30-day free trial is going away at midnight on December 31st. Right now, you get the daily report, the tradable signals. You get my opinion on the best trades. You get full backtested data to show our reports were, stop loss levels, full tracking of trade returns, weekend updates on all of our positions, and more importantly, you want to trade right alongside me. You want to know what I'm trading? You want to know if I'm in that hot trade and what I think is going to happen? We'll jump on that free trial, because again, at the end of the year, it goes away because corporate finances have come under pressure as China contends with weak domestic demand and its longest stretch of deflation since 1999. And this means producer prices remain depressed and retail sales were weaker in November. But what have we been hearing here in the U.S.? That prices are going to go higher because American consumers believe that inflation's entrenched and that it can only go up because historically we've seen nothing but long-term disinflation. And finally, it's time that inflation's only going to go higher, that manufacturers are going to keep raising prices no matter what. Retailers are going to do the same thing. But when we look at what's going on with China and we then turn to the U.S. data, we can make a very clear case of why prices are coming down at the producer level. Because when we look at industrial production against the producer price index by commodity for final demand, that's shown in red. And again, both on a year-over-year rate of change, we can see is when production declines, it means demand's going down. And what does that tell you at the factory level? That prices are too high and the prices need to come down. And in the short term, what have we seen from producer prices? They've edged higher in red, which would suggest that demand's rising, but instead we see industrial production declining. What that means is prices are going to come down and industrial production is going to lead the way, indicating that the U.S. economy is not likely to experience a resurgence in inflation, because with China, it comes back to the consumer. With the U.S., it's all the same, because China's consumer slowdown shows the urgent need to encourage spending. So we compare the Chinese economy to the U.S. economy, and what do we see? Consumer slowdown in China now impacting the U.S. consumer, and this is going to be a huge problem because it all comes back to one critical factor, and that's the demand for labor. Retail sales rose 3% from a year ago, the slowest pace in 3 months, and undershooting even those bearish of forecasts. The data show that the recovery in domestic demand has remained sluggish, while the stabilization in industrial production was likely due to some order front-running ahead of the U.S. tariffs and is not sustainable. And that is the case that we've been making here, that there's been all of this front-loading from the tariffs, but not only that, it's holiday consumption. And what happens after the first of the year? Well, consumers cut their spending back because they have to pay down their debt. And right now, consumers are facing high interest rates on their credit cards, a slowing economy, hours worked at their jobs are getting cut, and some people are even hitting the unemployment line and getting stuck there. We're going to see a big drop in demand in the first of the year, and this is going to impact, of course, U.S. manufacturers as well, that we've already noted from the regional Fed surveys in December are already seeing a major slowdown. The weakening in retail sales showed the limits of a government initiative to stimulate consumption by subsidizing purchases of home appliances and cars. And this is something we've been talking about, that stimulus is only a short-term band-aid. You bring it out, it has a brief impact, and then it goes away. And here yet you see from Beijing, the expectation was, well, we'll offer a little bit of stimulus and the economy will boom. And as it turns out, people that did need appliances and cars bought them, and then everything started to fizzle out, but at the sacrifice of other parts of the economy, as sales for those two categories remained strong in November. Meanwhile, a number of discretionary goods recorded a slump. And the picture remains the supply-demand imbalance. And this is a case that we've been making, and why it comes back to labor. Because during the pandemic, what did we have? Demand was outpacing supply. Now what's happened since the economy has reopened, what do we see is supply is outpacing demand. When that happens, you don't need as many workers, and that is a huge problem, not just for China, not just for Europe, but for America and the entire global economy as well. And this points to a deflationary outlook, not just for China, but the U.S. And when you get that, well, you lose the labor market. Now let's take a look at industrial production, still shown in blue on a year-over-year rate of change against continued unemployment claims that just ticked over 1.9 million, and based on our data, is looking to go much higher. And we can go back to the 1960s, where we see a slowdown and eventual contraction in industrial production sent workers to the unemployment line where they remained. And we see that again in the 70s, 80s, 90s, 2000s, and even the mid-2000s, and now we're seeing it happen again with people getting stuck on unemployment, and we're finding out employers are not hiring. What it's telling us is industrial production is going to go down, as well as retail sales. More people are going to lose their job. America's economy is not immune to what's happening in China, because we now look at continued claims, still shown in red, against real retail sales. That's shown in blue on a year-over-year rate of change. And we can see once again, as people get on unemployment and get stuck there, as we see right around 2000, you see a deceleration and eventual contraction in real retail sales. The same thing happens once again going into the global financial crisis. And look now, you can see the big drop in real retail sales, which has remained negative for nearly 3 years running, coincided with a bottom in continued claims. As this heads higher, look for retail sales to flip from that brief positive move all the way back into negative territory, and that means we're going to see way more layoffs, not just in the industrial space, but in the retail space as well. The problem is there's going to be no opportunities for these workers to re-enter the workforce. And what that means is yields are going to head lower. While many people think that's not the case here in the U.S., but hang tight, because China's yield discount to treasuries now reaches the widest since 2002, as China's 10-year yields have fallen 254 basis points below those on similar U.S. bonds. That happened as China's yields plunged to a fresh record low this week after the Communist Party's top decision-making body pledged, quote, moderately loose monetary policy in 2025, its first pivot in nearly 14 years. But in the U.S., you get the exact opposite reaction. Investors hear that the Fed's cutting rates and trying to ease policy, and they believe long-term rates must go higher, so they've been shorting the long bond, dumping the long bond in big waves. But what you see in China is rates are falling because interest rates are a function of growth and inflation expectations, not market participants. Investors are now waiting for more concrete economic measures from Beijing, but it's not going to matter because it's way too late. The People's Bank of China is expected to further loosen monetary conditions and facilitate a larger government bond supply. And so while here in the U.S. people believe that an all-Republican government will lead to massive deficits and a large supply of new debt to drive long rates higher, what I want you to see in China is the exact opposite is happening. So while investors are positioning here for higher interest rates, what they're actually going to find out is interest rates along with the U.S. economy are going to plunge. China duration remains a buy on the dip because the changing growth model means that credit growth is unlikely to rebound sharply. And that is the case we've made with the U.S. data as we looked at industrial production, and we saw that as it goes down, it's declining because real retail sales are falling, and that means interest rates also must go down to stoke demand, and you can see it very clearly in this chart here as we look at industrial production still in blue against 10-year treasury yields in red, and you can see that there's a general relationship where the economy goes, yields fall, but this time the economy in the U.S. is slowing. Investors say no, it should be booming. What that's telling us is at some point yields are going to outright collapse along the intermediate and long end of the curve. But one thing that's really a big problem for China and the U.S. economy is the dollar, which now eyes its best year in almost a decade. The main pillar of support for the U.S. dollar this year has been the strength of the economy, and that strength means that the Fed is coalescing a shallow cutting cycle that leaves rates on the higher in the U.S. than elsewhere, helping sustain historically elevated dollar valuations. Well, I don't agree with that view. I think it has more to do with a global dollar shortage and the fact that trade is slowing down than it has to do with the fact that people want to hold dollars because they don't pay any interest. That's the issue. You'd be much better off instead of holding dollars buying treasury securities that do offer a yield premium, but we can see it also has something to do with speculators. The same thing that's impacting the long end of the treasury curve. We see speculators steadily boosting bullish dollar wagers as non-commercial speculative traders have steadily boosted bullish dollar bets on the run-up since the U.S. election. They now hold some $28.2 billion in contracts tied to a future rise in the greenback. And when we look at the Chinese economy and the world economy, everybody wants the dollar to remain relatively strong, but not too strong. In this case, the dollar going higher is really having a major impact on the global economy. It's threatening to send everything streaming right down into a recession. And this is a problem because what it means is we're actually facing a global currency crisis. The current dollar strength is consistent with incoming data. We do not think the markets have fully incorporated our tariff expectations, and risks to our forecast are still the upside over the medium term. This from Goldman, and Goldman's got it right in the sense that a stronger dollar has everything to do with a slowdown in global trade. So what the dollar is telling us, what we see in China in terms of industrial production, a decline in retail sales that's spreading all across Europe, that started here in the U.S., is telling us that the global economy is headed into a synchronized recession, possibly all-out financial crisis. And when we look at China, we can see where the U.S. economy is headed. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.